Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Monday, the 27th of May. I'm Daniel Lam, your host for the podcast. I remember back in the days when I was working as a strategist on the trading floor in a bulge bracket investment bank. The head of trading once said, "To be in the flow is to be in the know." That's very true. You do feel and see much more differently if you're part of the action versus being removed from it. So that's the reason why I read with very strong interest about the latest results of the US Conference Board measure of CEO confidence. After all, who would feel more than the actual head of various different companies compared to any other pundits? So that measure improved slightly in the second quarter of 2024, from 53 to 54. Now, a reading above 50 shows that optimistic perceptions of business conditions outweigh the pessimistic ones. So the second quarter survey results marks a second consecutive quarter of CEO optimism, following nearly 2 years of gloom. Now, notably, details of the report show that only 1/3 of CEOs now anticipate a recession within the next 12 to 18 months. That's down from 3/4 in the fourth quarter of 2023. Now, CEO confidence has typically been a leading indicator of the performance of cyclicals versus defensives. And this improved confidence would point towards further gains for cyclicals and, by extension, a good environment for risky assets in general. But, once again, I would like to play devil's advocate as I did last Thursday. And I would like to point out that the Conference Board surveys chief executive of large companies, but the smaller companies account for the lion's share of employment. Now, the hiring intention component of the National Federation of Independent Business Survey, NFIB, that is already on a downtrend, and that is a more comprehensive payroll indicator. Moreover, the details of the Conference Board report suggest that lingering concerns about labor shortages and the need to retain workers are leading to anticipated wage increases of 3% over the next 12 months. So higher input cost would hurt future earnings. Improved CEO confidence will feed into earnings calls and is likely to fuel investor sentiment further. It is also likely to raise earnings expectations. But we would need to continue to monitor the key figures such as non-farm payroll and inflation data. Now, as long as they are solid or show a very controlled slowdown, we can expect US equities to continue to be doing well in a Goldilocks environment. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.